All right, guys. So I wanted to tell you about a time we had $4 million committed to our fund and actually closed zero. Zilch. None of those investors. Yeah, we had just over $4 million in soft commitments for our $10 million fund, and we ended up with none of it. Not because our fund changed, not because investors didn't like us, not because we lacked belief in what we were doing. It was a systems failure. Actually, it was our failure to create the systems properly. And I wanted to walk you through exactly what happened and what I would do differently today in hopes to spark maybe some ideas for you and what things for you to avoid. So here's the story. We hosted a 3-day VIP invite-only retreat in Sedona, Arizona. We covered everything, rooms, food, it all. We ended up having about 15 potential investors show up. It was intimate, it was intentional, and with the lack of better words, it was powerful. It was such a memorable experience for all of us. Each of us partners had many opportunities to tell our story. We connected with these people. We educated them on why to invest into a fund and not a syndication. And here's the important part. Several of those people, they'd known us for years already. There was already history with some of them, already familiarity. So by the end of the retreat, when we invited them to provide us with a soft commitment, guess what? We had just over $4 million that came in as soft commits. And this was for our $10 million fund. We were ecstatic. We thought, well, we're halfway there. We're funded in just one weekend. This is amazing. And that's where we misunderstood what was actually happening. So looking back now, there are 2 what if questions that stick with me that I would like for you to reflect on as well. What if we had been nurturing and educating these people consistently for months, maybe a year before that retreat ever happened? What if the retreat wasn't the ignition like we were hoping, but just the acceleration of something already structured? And second, what if the momentum they left Sedona, they entered a system that continued reinforcing clarity automatically, keeping them primed, not random follow-up, not manual text from us, but structured consistency? Because here's what actually happened. We left with excitement, as you could imagine, but we had no infrastructure to back it up. The excitement faded very quickly, if I'm being honest. And during the few weeks after that retreat, yes, we were manually texting them. We were manually calling them. We were trying to stay in touch to keep them primed, but you probably are aware of what that feels like. It feels like you're chasing somebody nonstop. It feels like trying to maybe interpret silence, and slowly your momentum disappears. With some other opportunities came across their desk, maybe life shifted a little bit, priorities changed for some, the market shifted, I could remember this, and people were getting scared to invest. But by the time we were ready to accept funds, every single commitment was gone. And that's a super hard lesson for us that we had to learn. So here's real diagnosis. After thinking about this deeply, I realized something very important. Trust isn't just one thing. And I'll keep this short because my business partner, Dallin, goes into this and breaks this down into more fully aspect of it in another video. So go check that out. It's pretty awesome. But here's a framework. The 3 types of trust. There's observed trust. That's when they're watching you from afar, consuming content, maybe attending events, seeing how you operate. Then there's earned trust. That's when they take more action. They reply to your emails or your texts. They schedule calls. They review your pitch decks and material. And then the best one of all, there's associated trust. That's when someone they already trust refers them to you, a referral. Now, here's what's interesting. At that retreat, we had all 3 of these in different degrees. Some had known us for years, that's strong, observed, and associated trust. Some engaged deeply, that's earned trust. So why didn't it convert? Timing. I'm telling you, timing is the one variable you don't and can't control. Some of these investors absolutely trusted us, but it wasn't the right season for them. Maybe it was liquidity timing. It was their portfolio timing. You just, like personal things, right? You can't control when somebody is ready, but you can control whether you're prepared and ready when they become ready. And that's where systems matter. If you're raising capital, here are the 3 things I would never skip again. Number 1, prime before you present. If we had been nurturing and educating consistently before the retreat would have maybe amplified that momentum instead of trying to create the momentum. Priming looks like this: consistent education, transparent updates, risk conversations before a deal is active. By the time you present an opportunity, it shouldn't feel new to them. It should feel like the next step. Okay. Number 2, structure the aftermath. The moment somebody leaves your event, webinar, or your call, they should enter structured nurture automatically. Not this, oh, we'll touch base or follow up next week BS. This needs to be structured, consistent, and predictable. So I'm going to jump into my computer real quick. This is what we didn't have right here. This is a consistent system reinforcing clarity every single week. Raising capital isn't selling, it's attracting through education, updating them, reducing uncertainty slowly over time. That is structured trust. And point number 3 is to track their readiness. Don't guess their readiness. This is the big one. If somebody already trusts you, but maybe the timing isn't right, you need to know when timing changes for them. It is pretty difficult, but here are readiness signals you should be tracking. Number 1 is increase engagement in your CRM. Number 2 is registrations to your workshops or webinars. Number 3, maybe they're asking you questions on your social media. Number 4 is replying to emails. If you don't track that, you either chase too early or miss the window completely. So inside of Capitallyst Pro, we have what we call engagement scoring. And you can see it right here. You can also see it on their contact information as well. We can also see the leads' activity everywhere they go. Now, instead of guessing who's serious, you can see behavior in the system, and behavior tells you when the season shifts for them. And what's even better, you can set up automations to notify you when somebody hits a number of engagement score, and then maybe even assign a task to you to follow up with them or reach out manually. I just wanted to reframe this real quickly so you can stick with me. We didn't lose $4 million because trust wasn't there. It was there. We lost it because we didn't have infrastructure to support those investors' timing. So trust can exist, interest exists, excitement can exist, but without a proper and proven system, that momentum can dwindle very quickly. We saw this. Okay, you don't need a $30,000 retreat. You need a system that rhymes before you pitch, nurtures after, tracks engagement, flags readiness. This makes your capital raise more predictable because capital doesn't move at the speed of intensity. It moves at the speed of your consistency. Now, if this resonates with you, you're realizing your capital process feels emotional instead of engineered. There are resources below that show you what structured infrastructure actually looks like. Now, this is educational purpose only, okay? There are no guarantees in capital raising. Now, your execution and timing always matters. But I can tell you this from experience, consistency beats intensity every single time. At a certain level, capital raising stops being about conversations and starts being about your systems that you have in place. If you want to see how this system looks when engineered intentionally, we are hosting a webinar in a few days where we break down the full capital flow system. You can register using the link below in the description, and we just want to offer a clear look at what building predictable capital actually requires. We'll see you there.